real assets, machines, factories, knowledge, this is the productive capacity of our economy. This is the wealth of our economy. Wealth is we can produce more. We can consume more. So the real assets define the wealth of our economy. Financial assets, on the other hand, these are claims on the real assets and the income generated by those real assets. So I, as a corporation, might issue stock, I might issue debt. I use the money from that stock and debt issuance to buy a factory. I operate that factory, which generates cash flows. The cash flows generated by those assets in turn go back to the stock and to the debt holders. So real assets, productive capacity of our economy. Financial assets are the ownership of those assets and of the real assets and the income generated by those real assets. Examples of financial assets, as I mentioned, stock and debt. Interestingly, the sum of all financial assets in the economy is zero, right? So if a corporation issues a bond, that is a liability of the corporation, and I buy the bond, it's an asset to me. You sum those, and it's zero. So summing all financial assets across the economy is zero. However, and this is the key insight of what I want to say here, is that the financial assets have a real impact on the amount of real assets that we can create. So in other words, financial assets provide us with some very positive benefits. So for example, if there were no financial assets, and you would have to have if you want to create a factory, you have to create that factory with your own capital. However, because we have financial assets, well, I can sell stock to 1 million different people, and 1 million different people could give me small investments, and I can package those investments together and build a factory. So what that does very clearly is it unlocks capital, held by small investors, by people throughout the economy. So in that example, more factories can be built with financial assets and with good financial markets. So in other words, now in the US we have deep and very good financial markets. You could have $200, you put that into an ETF, and that flows into financial assets, right? So, and another example is because of how well our markets operate for financial assets, it's very easy to transfer ownership. So when you're buying and selling stock, you're transferring ownership in a company. Now, if I had to finance the entire corporation myself with my capital or with a few partners in a partnership, then it becomes very hard to transfer ownership. But you easily, so long as the market's open, can go out and buy stock in NVIDIA and buy ownership, right? So another key insight here is this gives you, so you can buy NVIDIA, but you can also turn around and sell NVIDIA. So if you have to buy NVIDIA and you have to hold it for a very long time, and it becomes very difficult to sell it, you'll pay less for NVIDIA. However, if you can easily sell it, you can change ownership at any time you're willing to pay more, right? Because you're willing to pay more for it, that is more capital that goes into that goes into the financial assets, which in turn buys more real assets. So while the sum of financial assets across the economy is zero, they have a real, measurable, positive impact on the amount of real assets that we have in our economy. So I have down here, the financial assets increase the amount of real assets that we have. Now, if we increase the amount of real assets that we have, that means more factories are being built, which this is increased economic growth, this is lower unemployment. So if we do our jobs well in finance and in investments, we increase economic growth. So everything we're doing here in finance ultimately should increase economic growth, right? If we do it well, if we can create sensible market rules and market regulations which allow the trading of these financial assets, creation of new financial assets, trading of these financial assets with good, we need to give investors a good idea of the income that they will generate. So good financial statements, reasonable accounting, and so forth. All of this goes into increase the amount of money that we can funnel into real assets, which will increase economic growth. And in fact, there's been a lot of research on the quality of markets and then the quality of market regulations, the depth of these markets, the amount that can be traded, and it's pretty clearly shown that the better the markets, the faster an economy grows. So real assets are the productive capacity, the wealth of our economy. Financial assets is how we divvy up those real assets and the income generated by them. And if we do well by creating good financial assets, we'll be able to finance more real assets and our economy will grow.